Hey, this is Wayne Wagner with Visionary Wealth Management. And today we've got a special guest. Erik Ogard is the Chief Investment Officer from WealthPlan Group. Erik worked for Russell Investments in senior executive positions for 20 years, he ran his own hedge fund. And we were privileged enough to get him as our Chief Investment Officer starting in 2021.
Two
Is that,
years ago. Yep.
you know, Erik's been with us for a couple of years now and has really added value to portfolio construction, how we're thinking about building and managing money today. And Eric, we're at a point in time where for a lot of our clients, we're seeing, hey, the S&P 500 or random indexes or they're up year to date, but diversified portfolios are not performing in line with the indexes right now. And so you and I have talked at length about this. We just thought we'd get the two of us on here and kick some things around. And we think that'll probably add some value to how we're thinking and guiding clients and that how our clients can think about it. Does that make sense today?
It does make sense. And let me just say, I'm really pleased to be here. I'm happy to talk markets with your clients and a broader audience. And as we say, or as I say, there's the headline number in the index and there's the subtext. And there's almost always a subtext. It's never as simple as just the index return.
Yeah. Yeah, for sure. We've been conservative with position. You and I have had conversations about how when you're in on the investment side, it's your job to stay invested at all times. And so it's our job to guide individual client decisions about whether to be aggressively positioned or conservatively positioned based on the cash flow needs of the specific household needs of our individual clients. And so you guys at WealthPlan, you have to stay invested all the time. And for us, we got a little conservative in late 21, right around the time that the market itself, the indexes themselves were actually peaking out. And that really served us well in 22. It's not serving us as well in 2023 because diversification isn't really working this year. Can you maybe speak to how the index is made up today and where you're seeing the kind of the positive performance versus, like you said, the subtext?
Sure. And I think while we're talking diversification, maybe we start with a big picture view. And that would be that when you approach diversification, the old school is 60% stocks, 40% bonds, set it and forget it.
Right.
And normally you get a yin and yang there. So if the stock market's correcting, bonds provide some ballast to the portfolio. If bonds are not having a particularly good period, maybe the stock market's ripping, and you put those two together and you get a nice moderate return with a lot less volatility than you'd get if you were 100% stocks and not much of a give up in return. That's the thinking. And then at Wealth Plan, we had this idea many years ago. I came into this context, but it's something that we had embraced at prior shops too, which is alternatives that are thoughtfully constructed and designed ought to be able to give you something at the portfolio level, like lower volatility or holding up in down markets. And so we have, instead of a two-pronged stool, stocks, bonds, we have a three-pronged stool, stock, bonds, alts. And
Right.
that's a very useful thing for many investors, not everybody, but for many investors to have. And
Right.
so now we're zeroing in on what's going on the equity piece. But let's just remind people, in 2022, we had stocks down and we had bonds down, and it was the worst rout in bonds in a century.
Mm.
And normally you get bonds holding things up. And so that was 2022 was painful for folks because what they had hoped to get from a 60/40 portfolio, they didn't get. And then, so in fact, I wrote an article 2 weeks ago called Befuddling Markets. And it's really about the stuff I think we're going to talk about next, which is what's going on inside of the equity markets. What should we be expecting from our portfolios?
Right.
Most people, their reference point is the S&P 500 index or it's the NASDAQ. Either way, those are cap weighted indexes and they can be dominated by just a few stocks.
Right.
That happened in the late 1960s in an era called Nifty 50, when just a few companies were driving the index. And that was an exciting time. Companies like IBM and Polaroid, names from the past, Xerox, that
Well,
almost,
don't even exist anymore.
but yeah, almost nobody even thinks about those names now, but they were driving a very narrow market leading into the 1970s. And then we had an incredibly narrow market in 1999, something that I lived through. I've been doing this now for 33 years, if you can believe it. And now in 2000, we had an incredibly narrow market, and we all know the names back in the day, right? It was Cisco Systems. It was Microsoft with the internet browser. It was all the tech names with a very narrow market.
Right.
Here we are again now with new technology, artificial intelligence, really driving the stock market rally year to date. And in fact, this is one of the most narrow markets you could get. If you didn't have the top 10 capitalization names, pretty much, you have a flat return year to date, flat to down a little bit. And so to look at the S&P index and say, I ought to be up because the S&P's up or the NASDAQ is up is ignoring the fact that it is just a small handful of stocks that have driven the result. And
Right.
the last point I'll make is if you compare the S&P cap weighted index, which is the headline index that everybody talks about, to the equally weighted S&P, the gap is huge. So if you had the same stocks, but at different weighting, equal weighted, you have no return to your date. So this is all about AI.
Yeah.
And it's all about the new technology that is going to bring AI to the masses.
Now, correct me if I'm wrong. AI is a deep well, and we're not going to plumb the depths of it today. But in the late 90s, it was the tech boom, but it was really the internet.
Yeah.
And so it was this expectation that the internet was going to add this exponential value, exponentially change, radically alter how the economy was structured. And that happened. We saw that play out in the late 90s. But then we really had the realization set in that company profits weren't going to suddenly go to the moon just because they put a website on the internet. And it took a massive correction in 2000, from 2000 to 2002, and then subsequent years of evolution for the actual profits associated with the internet boom to come to fruition. Are we maybe seeing some of that today, that there's this expectation AI is going to radically alter the profitability of these companies in the next 6, 12, 18 months? And that's why the multiples have run out as far and as wide as they have? Or am I missing something?
No, I think there's an element of that. Now, if you go back to that boom from 1999, 2000, some of those names went on to make higher highs and have powered through that period. And you look back and you say, I could have bought them on the most expensive day in early 2000, and I would have made money if I held on long enough and a reasonable rate. However, think of Cisco Systems. I was just looking at that stock relative to its long-term history. It's still not above where it was in 2000. And Cisco System, if you'll recall, was the backbone of the internet with the switches and routers and everything that was enabling the internet. So if there's something that could potentially be an analog to or analogous to Cisco, maybe NVIDIA, but I'm of the mind that NVIDIA has got a long way to go. We're going to find out.
Yeah. Okay. Yeah, I know that we've been talking about, we're not going to make specific investor recommendations today, but I know that's been a topic of discussion on the investment board at WealthPlan and NVIDIA and some of the other AI names. And how do we participate? How do we capitalize? And how do we make sure that we're not buying a Cisco in 1999 and sitting here 24 years later with the stock down? So I certainly don't have that patience, and I know that our clients don't have that level of patience.
That's right. You want to avoid those situations, and normally a strong valuation discipline will keep you out of those kinds of situations. But investing is always an uncertain game because you're making a choice about a future that is unknown.
Yeah.
Um,
And
that
things have shifted in terms of how companies approach the whole earnings constructs, right? So companies are able to stay private far longer between angel investors and private equity and venture capital. They're able to stay private much longer. They're able to take an approach much like Amazon did for really a very long time, and they still don't have massive earnings numbers relative to their revenue because they're constantly plowing the money back into. And so the markets have really come to value companies based on their potential, not necessarily their actual earning. And that's is, am I wrong, or is that different than maybe things that we've seen in different eras?
It's definitely different. It's a crowding out of the public markets in the private market sphere.
Uh,
And in fact, if you ask yourself, where are the most interesting emerging AI technologies? They're private, they're not public, and they're held by the big tech giants that have been ripping this year. One way to try to participate in that emergent technology is to own these bigger cap names that have private investments into private AI companies that in all likelihood will maybe be spinning out someday. But again, at a higher valuation and later in the cycle than we typically used to see, say in the mid 90s.
That's actually really helpful, Eric, because when I think about that, how do we participate? One of the frustrations I have is that because companies are staying private so much longer, that really Main Street investors, our clients who are investing through their 401ks or through the traditional markets, get robbed of those early, the small cap and mid cap growth engines that used to exist in the market 20, 30, 40 years ago, because those companies stayed private. And it's the private, if the private equity holders that are able to reap the rewards of those early stage performance. But what I hear you saying is that if we can identify who those private names are, but then look at who some of their shareholders are, maybe they are the big top 10, top 20 names that are household names, the Googles, the Metas, the Microsofts of the world that have private equity, that where the publicly traded company actually owns some of the private equity. That's a different way to capitalize on those private names. We don't have to try to find some eclectic hedge fund or private equity fund that we're going to go invest in. We can actually get some access to buying. So,
That is true. Yep.
okay. Yeah,
And
that's
we can think of that as a top down approach to AI. I think humanity learns from past eras. And we've all seen the case studies that if the railroads had defined themselves as transportation companies, they may have had a different experience. And so I think these modern tech companies, because they were founded in, let's call it revolutionary technology, they know how disruptive revolutionary technology can be. And I think they're going to keep reinventing themselves. They've learned from that past that you
right.
can't be confining in the description of yourselves and the service you offer to clients. Look at how Amazon started as a bookseller and then launched into selling everything on a digitally enabled technology base. So I see it as we're more involved and more sophisticated in the capitalist machinery that supports innovation. And so therefore, the big tech companies are going to be at the forefront of innovation, I believe. And just look at what Microsoft did purchasing ChatGPT or OpenAI and unleashing ChatGPT into their suite of software.
Right.
That's just one example. This is how the modern technology company thinks. It's a very expansive, open concept of what they do. It's not narrowly defined.
It's interesting. Again, we don't want to go too far down rabbit holes, but even a situation like Microsoft's an interesting one because Bill Gates has donated a lot of his Microsoft stock into his foundation. And so the foundation doesn't, can really hold that stock forever. And so it reduces how accountable to the public markets he has to be, or the company has to be on a short-term basis, because these long-term, what will end up being generational long holds are happening at the institutional level for many of these companies, which is interesting. There's a whole other field of the sphere going on where you've got the big players, the Black Rocks, the Vanguards, the State Streets that control. They own something like over 85% of the individual names within the S&P 500, and they own huge swaths of those companies. And so that's a whole different category. And I think that maybe seeing some of the unwinding of some of the ESG vernacular and the greenwashing and that kind of stuff. But that's probably a topic for a different day. So
A whole can of worms right there.
I think for
I
sure.
don't have a strong taste for worms.
So, yeah, that's been. I've had. We have a couple of clients who are really knowledgeable about environmental issues and those kinds of things. I've learned so much from those conversations with our clients. But so much of what we see when we see ESG investing and that kind of stuff on funds has been, and those clients that have gone through some of those funds and looked at them and said, "Look, these aren't ESG funds. These companies aren't meeting the ESG criteria that we would have or define, but everybody's got their own little definition of what is ESG. And so they put their little stamp of our personalized stamp of approval that the stocks in this fund meet our criteria, but everybody's got a different criteria.
That's right. Nature hates a vacuum. And if you create a vacuum, it will be filled.
Right.
And that's why when you have a loosely defined thing like ESG,
Yeah.
it's a vacuum that gets filled.
Yeah.
That's how,
And
without being overly jaundiced.
yeah. On the product peddler side, the product construction companies are basically always looking for a way that how can we sell this to you and charge you more for doing the same thing we were doing yesterday. And so if we can get people to, we see when we look at my Christian faith, you'll have companies that do the same thing. We invest in a manner that's consistent with the Christian faith, and then you dig into it, and it's we're not doing this or we're not doing that. But it doesn't mean necessarily that it's all consistent with my Christian, because I would have a different criteria than anybody else. And so it's the ESG thing has become. Hopefully, we're seeing some unwinding there, but it's become a little bit of a religious moniker where you see funds that are generally underperforming, but they generally underperform the indexes. But hey, the fund company gets to charge more because it's an ESG fund.
Yep.
All right, onward and upward. Let's shift gears So what I'm hearing you say is that the top 10 names in the S&P 500 by market cap, and market cap is the total value of the company as to like you said, market cap weighted versus equal weighted. We're getting radically different outcomes this year in terms of performance. And ironically, when we dig through the portfolios we have at WealthPlan, we own most of these big tech names. We just own them on more of an equal weighting, and we don't have 30 or 40% of our clients' portfolios in any one sector, let alone the tech sector. So, which will tend to have more volatility to it. So let's talk about, is it okay to shift gears to
Sure.
where the data is today and that kind of thing?
Sure.
So I have been personally since late 2021, I've been a little morose on the markets in general. I've been just feeling that there's too much debt being run up at the federal level. Interest rates go through the roof in 2022 and that kind of thing. And we're seeing sudden and bonds taking on the chin, the same as stocks last year. It was just a really challenging year. And we come into this year and I really don't see a whole lot of shift in the data. We're piling on more debt. I sat in a conference in California a few weeks ago and listened to one of the bond Grunlack. I forget his first name.
Jeff Gunlock. Yeah.
Jeff Gunlock. And he made a comment. He said, listen, the federal government is spending 8% of GDP on deficit spending. So this isn't
On the interest.
Oh, is that interest?
Just on interest.
Right.
About $1 trillion, a third of the annual budget goes to paying interest.
Right. So a third of the annual budget is now going to interest. What he was actually saying was that you and I would look at it and say, hey, we've got 2% GDP growth. We're not in a recession. But that when you look at what the government's deficit spending is right now, it's actually about 8% of GDP. And so if you suck out if you just told the government, hey, you guys can't put any more money on the credit card, that GDP would go from +2 to -6 in a heartbeat. And he pointed out -6% GDP growth is akin to the worst quarters of the 2008 recession. And now he's a bond guy. He needs things to get ugly so that he can make money, right? So there's a little bit of the bond guys always have to be a little more bearish than everybody else. But that was a start. That was almost an astonishing statistic to me because part of what we're seeing is I'm looking at commercial real estate where large cities are having trouble filling office spaces. Office space is going, is vacancies are rising there. We've got a very abnormally high amount of corporate debt and commercial real estate debt that starts to roll over starting in late this year and into the next 3 years. The federal government estimates are has to float either through additional borrowing or restructuring bonds that are coming due, something like $10 trillion in the next couple of years. Meanwhile, things like 4-week rolling bankruptcies are now eclipsing the 2008 worst case scenarios and things like that. And all of those data points lead me to, hey, if we're considering a conservatively positioned, I want to stay conservatively positioned. I don't want to go trying to buy NVIDIA right now. I don't want to try to catch it. Hey, maybe this sector's down enough and risk catching a falling knife. Maybe I just want to sit back and collect a little bit of higher interest on my bonds, collect a nice heavy dividend on our dividend aristocrat portfolio, and wait for a better set of waves to surf. Am I like completely off base here? What are you guys seeing at the WealthPlan level?
Well, we try to see it as neutrally as possible or try to see it as objectively as possible and look at all sides.
Right.
The reality is at any point in time, you can paint it black or you can paint it rosy. And we try to see all sides and not paint it either way. There'll be times when we say, look, things are just overwhelmingly positive or overwhelmingly negative, but almost always there's a balance to things and there's an argument on the other side. And that's why we have markets. And when I look at things, I do agree the US financial house is not particularly in order right now. And the congressional spending is the thing that doesn't really quite jibe with what the Fed is doing with rates in its balance sheet to combat inflation. On the other hand, if you ask yourself, what's the best tactic historically for helping your money to survive an inflationary cycle? Stocks overall tend to be a pretty good way to handle inflation. So maybe it is that stocks are holding up relative to bonds right now because they're the best way to keep up with inflation. Just another side here. Now, I don't think the PE multiple on the market is not something that gives me comfort, right? Like to me, stuff's kind of fully priced. If you look at what the S&P 500 index is going to earn this year in aggregate, it's going to earn somewhere around 220, maybe a little lower, maybe a little higher, between 210, 220.
Right.
And if you use a trailing multiple of 20 times on that,
Clarify, 210, 220. That means if you own one share of all 500 stocks in the S&P 500, that would represent about $210 to $220 of actual earnings.
Okay. Yes. So that's for 2023. So say we roll forward to December 31st and the number comes in at 220 and the market is trading at 4,500. That's basically 20 times trailing earnings.
Right.
And the thing that I struggle with is when you go back and look at higher rate environments, and we're not in a historically higher rate environment, but we've certainly rapidly ascended on the rate front.
Right.
I think a trailing multiple of 15 is maybe more appropriate. We haven't had a PE adjustment. Now, maybe that PE adjustment has to happen in just these big names to get the
Right.
overall market into a normal level, but we certainly are not in a position of comfort when it comes to PE multiple. That's given the rate environment, I think that's a reasonable thing to conclude right now.
Right. So what I just heard, think I just heard you say is that if more reasonable current year PE ratio might be something more akin to 15, that doesn't mean that now, I think that what that means is that if you took a PE multiple from 20 to 15, it means a 25% drop in the stock market. But what you followed that up with is that the whole market doesn't need to go down by 25% because you've got these inflated pieces within the technology sector that are substantially high. First of all, they're high earnings. Like they make up a high percentage of that $220 a share earnings, number one. And number two, they're trading at substantially more than 20 times earnings. So let some of the air out of those most inflated names and you could get the same net effect on the
Yeah.
overall.
And this is maybe just a simple logical statement that everybody gets, but you can get there in two ways. The price can come down or the earnings can rapidly accelerate.
Right.
And so, or maybe you get a little of both. But, right now, the aggregate consensus expectation on the S&P for 2024, 1 year out, is
Right.
250. So, like literally, the consensus is expecting something on the order of a 12 to 13% earnings increase in this environment. Is that
Huh.
going to happen? Only time will tell.
Yeah. And I guess my bearish counter argument to that would be, we're operating in an environment right now where the average mortgage payment in the United States just hit $2,900 a month. And so if you're going to spend 30% of your gross income on on your housing, which is the way banks underwrite mortgages, theoretically, you should be looking at, you need to make about $117,000 a year of gross to be able to afford the median house in this country. Meanwhile, the median household income in the country is $75,000. So the median income household can't afford the median income house. And it's not close because you'd have to increase that income by 50% for the median household to be able to afford the median house. And I talked to a builder a couple of weeks ago who they build about 500 high-end homes on the outskirts of Philadelphia. And he said, look, a family that could afford an $800,000 house a year ago, because interest rates are where they are, they can only afford a $650,000 house. Meanwhile, that same house from a year ago is now selling for $900,000. So you have a radical restructuring on the housing side, in addition to structural underbuilding, and then a high percentage of those houses are not coming to market because, hey, if I've got a 3.5% mortgage or a 2.75% mortgage, I can't afford to take a new job in another town because I can't afford to move into a 7.5% mortgage rate. Um,
Yep.
so
And keep in mind that 70% of GDP is driven by consumers. So the consumer's under pressure due to inflation
yeah,
and due to rising rates. It doesn't take a heroic forecast to say things are going to slow down. The
right,
question, it's so when you're trying to forecast, you're thinking about direction first, and then you're trying to think about magnitude.
right.
And there's disagreement on direction, there's disagreement on magnitude, and there's disagreement on duration right now. And when you add all of that up, you can say, what side would you rather end up on? A more cautious stance or a more aggressive stance?
Right.
And that can come down to horizon, individuals' horizons,
Right.
how much risk they're comfortable with. But it's fair to say the odds seem to me like we could have more downside than is typical in a typical environment. And if we do have more downside, are you comfortable taking that hit as an investor?
Right. Right. So let me put together two things you just said over the last couple of minutes. One is S&P 500 is being priced and the expectation is 12 to 13% earnings growth. But then you said there's pretty wide consensus that there's going to be some kind of a slowdown economically. So in theory, the way the markets are priced right now, the markets are expecting 12 to 13% earnings growth out of the S&P while the economy slows down.
Well, see, yeah, you've got a bottom up analyst driven earnings expectation on the S&P. So every company in the S&P has a cadre of analysts covering it and making estimates for the next 12, 24 months in earnings. Then those are aggregated up. That's the bottom up, call it the microeconomic approach to earnings. And then there are macroeconomists that say, here's the setup. It could be, we could be looking at not a soft landing, but something that's a little harsher, the degree to which we don't know the, we don't know the magnitude or the duration. And those things are a little bit at loggerheads. There's some disagreement there. And this has been a debate that's been going on for a long time now, hard landing versus soft landing. And it's still not resolved. Yet we've seen some pretty high profile folks come out and say, hey, you need to be prepared for some downside.
Right. Yeah. Okay. And that's the way we have asked our clients to think about this, to see, keep having some dry powder. If folks are retired, we always want to know where. We use a little bit of a formula, A plus B plus 5C, where A is cash, B is the access to safe money, and C is the earnings on the portfolios, so the dividends and interests and so forth. We always want that. If you're retired, you always want that kind of little formula to equal at least 5 years worth of your needed cash flow within the portfolio, so that we're always setting up for, hey, if we're going to go through some kind of, a really challenging season for the market, we want to be able to have your retirement cash flow taken care of, apart from really your equity exposure. We don't want to be in a situation where equities take a dip for 12, 24, 36 months, and we're suddenly have to sell equities historically at the end of 2008, March of 2020, 2002. We don't want clients having to sell equities at depressed prices to meet current day cash flow. And so that's part of the financial planning process on our side. It's individual client specific, right? Okay.
Yep.
What are we missing? So we've talked about a lot of data points. We've talked a little bit about, hey, there's maybe some disconnect, and maybe else the markets are maybe priced a bit more for perfection. Can we, I guess one other area I'd ask your input on or perspective would be the labor markets. We've seen more strikes this year than at any point in my professional career. And the headlines is the actors and Screen Actors Guild and the Writers Guild, that kind of stuff. But we're seeing Kaiser Permanente employees around on strike right now on the West Coast, things like that. I see that as labor stepping in and into that, that average, like that median household not being able to afford the median house, or labor stepping in and going to business. You have to pay us more, because it's not just that you guys can walk out with 12 or 13% profit increase expectations, while our average rank and file employee at labor union workforce can't afford the median family house. There's a disconnect there. And so labor unions are having, I think, a bit of a resurgence against that backdrop. Do you see that actually having an impact on earnings? Will companies have to actually give something back and provide some concessions here?
Yeah, potentially. And bearing the economic brunt of a societal shift needs to be borne by everyone, basically. And so the unions argue, I think this time rather forcefully, that the imbalance was too great and they needed some help from corporations. And within our system, I think the unions have a place to represent folks that wouldn't have a voice if they weren't organized. And so I think it's an important role that keeps the economic machinery in check. If you go back to France, they would just take the king's head. What would you what would you rather have? A labor concession or your head? So that's how I view it.
That might be a conversation for a few politicians that we could, it would be a harder discussion. But anyway,
The last thing I'll say is we've worked pretty hard on our alternatives investment approach at Wealth Plan, and alternatives aren't right for everybody. But we defined it pretty narrowly. We wanted daily liquid alternatives that reduced exposure to stocks and bonds, that had a chance to make returns in any market environment, so that if we had a bad bond and stock market, we might get some help. So we retooled that fund about a little over a year ago. We call it an absolute return portfolio. And over the third quarter, when stocks and bonds were down again this year, so in 2023, we had a down stock market and a down bond market, and our alternatives were up in the quarter. And so one of our analysts coined the phrase crisis alpha, which
right.
I absolutely love that. And I think we can make the claim that a lot of these hedge funds are just stock market exposure. It's beta in disguise. And we don't think you should have that as an alternative, and we don't think you should pay up for it. And so our definition of alts is to really provide something that when bonds and stocks together fail, we still have something to show. And then the other thing I would say is, for the first time in a long time, we have high rates, and you can get a return in a money market strategy for 5.5% right.
Right.
So
Yeah.
the question is, now we have to beat inflation over the long term. So you have to have a positive real return relative to inflation. But if that's where money markets are today, we certainly have to consider that as something that we need to either beat or have some exposure to, because if you're looking for a place to hide, that's not a bad place to hide.
Right. Yeah. And I think the other side of that is when we look back historically, and the fact of the matter is you've been doing this 33 years. I've been doing this 27 years, and neither one of us has really managed money in a rising interest rate environment. It's been that long since there's been any kind of a sustained rising interest rate environment that would negatively impact the bond market. So for most of my investing career and management career with clients, it's been decreasing rates until we bottomed out the last 2 years. And I remember in late 21, I sat in a room, listened to a guy he was with a big company that I won't pick on their name, but he was just about pounding the table saying rates are going to be low for the rest of your professional lives. Everybody in this room, I don't care how old you are, nobody can afford high rates. The government won't be able to afford their debt. Companies will default. And I walked out of that room thinking, that guy was so dogmatic that I think that the universe and karma have a way of taking things when people are really dogmatic, that the universe conspires to prove them wrong. And I walked out of it thinking, man, I don't know how, I think that guy's wrong. Or I think that history is going to prove him wrong just to spite him. And we're sitting here about 18 to 20 months later, and 22 months later. And yeah, it's a different world than where we were 2 years ago with the interest rate environment. Sure.
Not to get too heady, there was a point in time where Newtonian physics dominated science. Along comes quantum physics, upending Newtonian physics and changing the way we see the physical world. There's always something around the corner to destabilize what we think is bedrock, right? And
Right.
so you always want to keep an open mind, at least so that you don't have an embarrassing headline saying that you thought something was going to happen for sure, right? Really hard to take that kind of stand.
Yeah. And that's that. So we want to be balanced in how we're, bringing value to clients and adding value to clients for sure. And warrants, certainly warrants balance and diversification. As when we look back over longer periods of time, our clients have done great. It's just, this year I think there's some anxiety on my end because I feel like we're disappointing clients. And I've talked with a number of other advisors who are saying, hey, I haven't lost sleep like this since 2008, 2009, when things were really bad. But it just, so yeah, I'm grateful for this time. Are there any other topics that you feel like we should cover today? Anything we should go deep on? Please not Newtonian physics or quantum physics. Yeah. There's a reason they call people like you guys propeller heads. It's because your brains are always spinning in ways that we can't even comprehend.
So I guess one thing I want to touch on is that every week I write a note on the capital markets, something interesting, something to think about. I'd encourage people to give a read on those notes because I try to keep them kind of down the middle and keep some mass market appeal and what I'm talking about and thinking about. And so that can be useful for thoughts and commentary and perspective. And
Ask AI, right?
this past week, I just did a piece called The AI Gold Rush. And ironically, Motley Fool on the same day announced a piece called The AI Gold Rush or something very close. The zeitgeist is prevalent.
So,
But what I'd like to say is, and I did a note a few weeks ago on the long-term returns to stocks. If you get caught up in the short term, maybe you lose sight of the fact that we're trying to, as investors, we're trying to tap the power of capital markets over long swaths of time to increase our wealth. All of us we're like farm animals at the trough getting our water. That the capital markets are providing us with something we want. In the short term, the water might be dry, it might be rancid, it might not always be cool and refreshing and clear and delicious. But over the long term, the experience tends to be that you get what you want from the water trough of the capital markets. And that long-term perspective is always the thing to keep in mind, particularly when things are volatile, uncertain, or scary, because that entire history is filled with scary, uncertain, unpredictable, and yet with a long enough horizon, US, the US capitalistic free markets mechanism finds a way to deliver wealth to investors.
right. Yeah. And so to the extent that things are not rosy in the US, the fact of the matter is, if the world economy, if every nation shows up to the economic ball, it's an ugly kid ball these days, and the United States is the least ugly kid at the ugly kid ball.
Or we like to say the cleanest shirt in the laundry.
Okay, that's fair.
And maybe we touch a little bit on the international scene because US stocks are more expensive than the rest of the world. If you look at market cap to GDP or some other measure of stock market valuation relative to fundamentals of all the different countries out there, we are far and away the most expensive and we far and away outperformed almost all other economies. But keep in mind when you're investing in large US multinational stocks, they all have foreign trade.
Right.
So they're extracting something from the global markets. But, you know, when we come to a period in time where, say, emerging markets or even the smaller countries called frontier markets have their time in the sun, and they will have their time in the sun because they always do. There'll be a time when we had really wished we had some direct exposure to frontier and emerging markets. Now, we got a little of that in some of our portfolios that we manage at WealthPlan, but there's going to come a time where that will be once again a dominant headline for a time. We're just not there yet.
Okay. Eric, thank you so much for your time today. I'm grateful on behalf of my clients and our clients, and I know that our clients are grateful for the perspective. Um, you and the team at WealthPlan are the backbone of what we're doing on the portfolio construction, because we certainly couldn't research all of these stocks and do all of the trading and everything in-house at Visionary. So you guys, and you help make us better. And the business model that we've developed together for our clients continues to be one of the most streamlined I've seen in the industry. So I'm just grateful for our relationship with you, with WealthPlan, and how that brings value and adds value to our clients here at Visionary. So
On the other side, we're obviously very appreciative, and we get to do the things that we view as just tremendously fun. And at the same time, provide some value to your clients and to your practice. And so it's what they call the symbiotic relationship. Everybody wins. And it's been a great pleasure being on with you and your clients. And hopefully we get a chance to do it again.
great. Very good. Thanks again, Eric.
You bet.
For you who are seeing this, again, my name's Wayne Wagner, Visionary Wealth Management. We're always here to help you envision more. And today, envisioning more was all about the markets. Thanks so much for sharing this time with us. Take care.